Welcome to the Gray Report. I'm your host, Spencer Gray, joined by Griffin Haddad. Every single week on the Gray Report, we are breaking down all the latest research reports, articles, and opinions surrounding the multifamily industry, but also touching on other commercial real estate assets, housing market, and the macro economy. We're doing another live episode today, getting ready for our exciting webinar next week on our 2026 Midwest multifamily forecast, which you're not going to want to miss. There's a link right down below. We'll probably drop it in the chat here in a couple minutes. You want to register for that. Again, it's going to be a live webinar this upcoming Tuesday, 2 p.m. Eastern. We're going to be breaking down the top Midwestern markets and what that environment's going to look like in 2026. Great episode today. I don't know why. I'm really excited for today's episode. Not only do we have some interesting reports covering another market from our Midwest market forecast, but also a piece from John Burns Research and Consulting. We're going to give an update from Apartment List, as we usually do once a month, and then a piece on affordability from Oxford Economics. Then after we get through all of that, Griffin and I are going to be talking about why should someone invest in multifamily? And then also why someone maybe shouldn't invest in multifamily. What are the advantages, some of the disadvantages? And after having hundreds, if not 1,000 or more conversations with investors of all sizes and shapes, and Griffin has had so many also, we're going to be talking about just some of those different perspectives, the motivations from those investors. Again, it can be entirely different. An institution is going to be investing differently from a small retail investor. So all that and more, you're going to stick around throughout the entire episode. We're live right now, so if you are watching this on the live stream, thank you for stumbling upon this. We didn't really tell anybody we were going to do it. Drop some comment. If you have a question, put it in the chat. We will get back to you right away. And if you're not watching this live, that's okay. It's going to be a great episode designed for a little bit more evergreen content. You can drop those questions in the comments below. Let us know if you like this content, what you'd like to see, or if you'd like to see something completely different, if we're right, or if we're just flat out wrong. We'd love to hear from you. Griffin, how's it going? How you doing this week?
Great today. You just dropped some good news on me earlier today. We've got our first RSVP for our live webinar to cover our Midwest multifamily forecast. None other than data scientist and co-author John Chapman will be joining us, which is quite exciting. That was unconfirmed until this morning.
Oh, good. I'm glad he's going to be here. John is the data scientist here at Great Capital that did a lot of the groundwork on putting this report together. Yeah. And, unlike even some of our previous research reports that Great Capital has put out, or other reports that, other groups may put out, even pretty large research institutions, we're not just taking data from a secondary or primary source and kind of just representing that data in a different format. This is taking raw data and building out proprietary models that John has created himself to be able to give us some insights for next year. Now, are we painting a completely different picture than sources like CoStar? Not necessarily, but we certainly are starting to see some discrepancies as other data providers come out with some of their forecasts. And it's always interesting. We've done this in the past to compare projections or also just historic rent growth trackers. And there's always a little bit of variability. And a lot of it's the method. And why I think ours is really interesting and could be more accurate than some of the others is that we weren't attempting to do every single market in the United States. We were really focused in on these select Midwest markets and had to make slight adjustments to make sure those input variables were going to be appropriate for those markets. It's not easy to do, as John will explain, especially on some of these smaller markets where there's not as much data. Like a market like Lansing, which we can just jump into and talk about right now. You see down here at starts, there's not exactly a bunch of starts each quarter. And for building a model for Lansing versus the model for Chicago or Columbus, where you have just a ton of data, you can't necessarily take the same approach because the models don't like those negative numbers. And so it starts doing weird things. And so some alternative approaches are necessary to get the output that we think is going to be a more accurate forecast than if we just use a one-size-fits-all model. I'm still a layman when it comes to machine learning, putting these models together. What John does is really interesting. So that's why he's going to be here next week to explain it.
And that's why it was such great news that you dropped on me this morning, because John's a whiz kid, very intelligent. He's got an incredible brain when it comes to numbers, but also this operating model that he's developed. There's nobody that could articulate its value and its processes better than he. And so for you and I to sit here and attempt to put words in his mouth would be unfavorable to him and probably our report. So I'm looking forward to having John and his personality here, but also his intelligence and ability to articulate our methodology in this report. So our watchers, our audience, and our listeners can more appropriately understand how we got to these forecasts.
Yeah, going through all the methodology. If you'd like a sneak peek of the report before the webinar, you can go to graycapitalllc.com. You'll be able to access the report right then and there. Again, it's a blockbuster report, some really actionable insights to help you make some smart decisions for 2026. And then again, just on Lansing, just have to highlight, we're projecting it to be one of the highest rent growth markets in the Midwest, and certainly well above the national projection, coming in a rent growth of around 1.9%. Again, the national projections are essentially flat, not a lot of rent growth next year. Vacancy, it's estimated that we're going to see a little bit increase of vacancy compared to 2025. In starts, we're going to see some more units, which I think it's different from many other markets. It's counter to the national narrative. And it's important just to underline how local markets and different markets behave differently. You can't just paint with a broad brush, because we're forecasting that starts are actually going to be picking up in Lansing through the end of 2025, all through 2026, partially because Lansing has seen strong demand, has seen positive rent growth, and the demand is clearly there, and developers are now catching up. So there's a lot of interesting nuance in all of these markets.
Right. Lansing specifically, and in the graph there, you can see the deceleration of the growth as it goes down and to the right. But you mentioned it earlier; it's one of the strongest rent growth markets in the Midwest, according to our forecast. And so I think it's this is the storyline of which markets can stay positive, which markets can stay afloat in 26 in regards to rent growth. And even at that 1.9% annual rent growth that we're projecting, for Lansing relative to other Midwestern markets, that's significant. And then, in comparison to the nation upon which, we essentially produce this report to do, 1.9%, coming down from what was, it almost looks like maybe 4.5%, what would have been Q4 and Q3 of 2025. It's just the storyline of the next upcoming years, deceleration, slowing of the growth. But Lansing will be one of the ones that, kind of leads the charge in the Midwest to keep us in the positive.
Yeah. I think that it's important to underline that, we're not projecting gangbuster rent growth, and that the supply, we delivered more apartments in the last year and a half, 2 years than we have in over 40 years. And so it's not surprising that there's a significant overhang, which is a potentially negative fundamental for a lot of multifamily investors. It's hard to underwrite when you have low rent growth, but that should keep asset prices relatively in check. There is a floor because there's enough buyers, and hopefully it gets some buyers moving back to the sideline so you can identify some attractive acquisition opportunities. Because again, when you buy one of these multifamily assets, I'm not buying it for 2026 rent growth. If we have a business plan that's 10 years long, I'm buying it for rent growth in 2026 through 2036. So I'm more interested in what the rent growth is in 2027, 2028. But that still means I can't pay nearly as much if I have a lower rent growth number or assumption in 2026.
Right.
So again, I think it's an opportunity to be nuanced, to be tactical, to find some of these strong basis plays that have high potential cash flow and rent growth in future years, even though you might not see a ton of rent growth in year one.
Right. And Lansing, take a look at the market. It's a state capital. It's got a major university, hospital system. The demand is there for the long term.
Yeah.
And so with its significant undersupply and drastic, reduction of deliveries and starts over the last X amount of years, that forward-looking approach to Lansing can be quite powerful.
Yeah, no, I agree 100%. We have a property in suburban Lansing in Okemos, and it's been one of the best performers in our portfolio over the last several years. Well, let's shift to a more national focus, looking at Apartment List, their national rent report for December 2025. And I'm assuming this is all covering mostly November numbers. And it's not a surprise. The median national rent fell 1% in November and now stands at $1,367. This was the fourth consecutive month-over-month decline. And now, as they note, we are in the midst of a market off season. But as they also mentioned later on in the piece, and this also comes back to the apartments.com report that we looked at last week, talking about kind of that change and shifting in seasonality. And there's essentially kind of like a flattening of the curve from that peak leasing season, kind of April through, July. We're seeing, the leasing season start a little bit earlier, and also kind of after a dip, kind of having a little bit of a surge in Q4. And so this is, while that narrative may still occur, that maybe we're not seeing as strong as declines as we could see, we're still seeing declines in not that kind of Q4 bump. Even though there is some demand we're seeing, at least in our portfolio, anecdotally, it's not leading to a large amount of rent growth.
I think for me, when I was reading this Apartment List piece, we've seen the rent growth negative month over month, really for, I think it was, I would say 4 months in a row now. Is that what they just, is that
Yeah.
what you, 4 months in a row? So the storyline has been maybe repetitive as I've accessed Apartment List and seen this report come month over month. The thing that struck me, maybe with the strongest umph was that the national multifamily vacancy rate at 7.2% is an all-time high, alongside with some rent deceleration or negative rent growth. And so it just speaks to the overall supply wave that we're still battling through. The peak wave of supply is really in our rear view, but we've been talking about it really all week since we were in Miami. We're still not through all of this deliveries and the supply wave. So the mix of negative rent growth with increasing vacancies, it's not a recipe for great NOI growth.
No, and you could see how an investor would just not be as bullish on multifamily right now if you just took a quick snapshot of where we are today. You mentioned that the Apartment List Index for vacancy, it is at an all-time high, and that was a little bit of a controversial data point because there was a couple outlets that picked up on that and were saying it's like apartment vacancy is an all-time high, and that's not necessarily the case. Now, it is true that it's at an all-time high according to Apartment List Index, but the Apartment List Index only goes back to 2019. So it's the highest vacancy since 2019, which is certainly a different, it's a little bit of a different narrative because we had higher vacancy back in the great financial crisis, and there have been other moments in history. So you really have to use the census to go back. And Jay Parsons on his podcast, The Rent Roll, went through this specific topic. And really the data sources that have there's only two data sources that really have the history for rental prices, and that's the census as well as RealPage, with the census having the oldest vacancy data. But it is interesting, even that data I think only goes back until the 80s, and we don't really have a lot of apartment multifamily data that spans back. It's all relatively kind of fresh.
35 years of history. That sure beats what is 5 to 6 years of history.
It definitely does. But I don't know, it's just still interesting and just that limited amount of information.
Right.
I mean, sometimes when I'm getting a little bit macro, but when we are trying to assess the macro economy, we often will go back and find analogs from history. But we've only had so many recessions over the last 100 and 20 years. Since we have are in this new economic paradigm, since we founded the Federal Reserve. We moved off the gold standard. Eventually in the 70s with Bretton Woods getting onto a pure fiat currency. It's a little bit of an experiment. We only have so much history with that, and we're still learning a lot. It's not like we have like 1,000 years of economic history of all these different examples,
Right.
even though there's a lot of human history going back quite some time. But yeah, this is, the question is, are we going to see, is this the darkness before the dawn? Does it get worse? Do we see vacancy continue to climb? And do we see rent growth continuing to decelerate and go further negative? I mean, we most likely will see a negative print for national rent growth in January. Big question is, in February, do we start to see the growth and how strong March is? Mm-hmm. Last year, March was the peak of rent growth, which was earlier than it typically is. So March is going to be a big month. And if you're a property manager, you're an owner, March isn't that far away. That's going to be here before you know it. And what are you going to be doing in February to capture that? Better be getting those renewals out if you haven't already. Moving on to John Burns, Research and Consulting, always putting out some really interesting content. And I thought, by the way, if you want to know like how we're pulling all these up, the best way to get all these articles all in one spot is to subscribe to the Gray Report newsletter. It's the companion to the podcast and the YouTube show that we're doing right now. And you can access it, sign up at graycapitalllc.com. There's a button, press it. All it takes is sending us over your email address, and you're going to get an email every Thursday at 8:30 a.m. It's packed full of all of these research reports and more. I mean, we typically highlight the most read, the most interesting, kind of a curated few. But I mean, Griffin, how many articles and links were on this last week's newsletter? I mean, at least 12.
Enough to keep you busy. That's for certain. Yeah, 12 is a good guess, and it covers multifamily specifically, and it's kind of our main section. But we also dive into macroeconomic and monetary policy. We're also covering other commercial real estate sectors, self-storage, really what's ever pertinent this week, whatever's kind of leading the headlines. And then there's always a challenge of mine as we put the newsletter together is to find the article that nobody else has yet reported on.
Yeah.
So that way there's something new and fresh when you do jump into the Gray Report. And most of the articles are very timely, but there's always one or two that come out the night before we release. So that way we can have what would be the freshest news in commercial real estate and multifamily housing.
The newsletter has been going on consistently without a break since kind of mid-2020 when we started it. That led to the creation of the Gray Report podcast that you're listening or watching right now. Griffin's been running the newsletter, does a great job, but we work pretty closely to get that to you, to be a really actionable and utilitarian newsletter. It's not really for us to sell you on investing with Gray Capital if you're an accredited investor. Although, always love to have those conversations if you think Gray Capital is going to be a good fit for you. Oh my gosh. Okay. Key takeaways. What I like about John Burns Research and Consulting is that they don't really pull any punches and they kind of just call it how it is. Multifamily transaction activity remains muted, challenging capital markets, macroeconomic uncertainty. The total units transacted over the trailing 4 quarters are 42% lower than the 2018 and 2019 levels. Now, on a dollar basis, the transaction volume is not as big of a difference. But again, looking at the amount of units, which is I think the right way to look at it, is how many deals have actually transacted. We're looking at a 42% reduction from kind of the pre-craziness of COVID. Investors are taking lower leverage, shorter term loans. They're betting on future interest rate declines, which depending on who you ask could be a risky proposition. Negative leverage persists with cap rates falling below multifamily interest rates. They've got an interesting graph a little bit later, looking at the equity spread historically and how that's really shrunk. And so you either have to be betting on some sort of cap rate compression or some sort of NOI growth to really make these deals pencil, unless you're getting just a really good deal. And there's just not as many investors who are willing to make that bet. They want a little bit more of a sure thing, or at least a little bit more of a spread, which is not surprising that it's difficult to raise equity, right, and that equity is holding out for really good deals. Makes sense,
right?
Again, multifamily transaction volumes have increased modestly, but they remain well below the pre-pandemic levels. And again, so the trailing they're only 24% lower than those 2018, 2019 levels on a dollar basis, but 42% lower on a unit basis. Here we are looking at a chart, looking at these volumes versus acquisition cap rate. And again, the spread between cap rates and U.S. Treasury, with the bars being the actual volume. I mean, you can see that when the spread between cap rates and interest rates was the largest, I mean, that's when everyone turned their buy signal on. And that was, starting in 2020, but really, again, at the end of 2020 into 2021. That's when it was really clear. And you can go back on our YouTube channel, and we've got a video of cap rates and interest rate spreads. And it was right during this time period. And I remember on the whiteboard, we were drawing in the spread. It was this massive spread, essentially saying like, this is a great time to buy, get fixed rate debt, because your cash flow, your spread is going to be so strong. Now, if you did buy during that time, which we did, and you fixed your debt, you could be in a really good position. We have some properties that are absolutely crushing it from this period. But now if you bought with the floating rate, you essentially kind of roll the dice on that spread, because as we all know, interest rates have gone up, floating rate, that spread is essentially has shrunk and completely evaporated. Then it's your ability to grow NOI, which in some markets you've been able to do that. Others, NOI popped up during 2021. Yeah. But, between 2022 and 2023, you started seeing, some rent declines, rent slowdown, you had inflation hit. So you actually had either a loss of NOI, or you had, NOI growth substantially slow down. And what I'm really trying to, I guess, get at is, the spread in this equity spread we'll look at it here in a second. It's not always indicative of a good time to invest. It certainly can allow you to lock in, again, like maybe a decent rate instead of your business plan, but it doesn't guarantee success. Right. As the most amount of distress and the foreclosures that we're seeing today were deals done during this period when, again, the spread was the best. So the spread is the worst. And I think the point I'm trying to make is it's not inherently the worst time to invest in multifamily just because that spread has gone away. In fact, it may even be a good time to invest getting in before it starts to widen again, or at least that's our base case. The equity spread remains negative, as we've been discussing, and the cap rates have been lower than interest rates for 8 consecutive quarters, meaning the debt is dilutive to cash flow upon acquisition. However, debt remains accretive to the project total return of the deal due to expected NOI growth. So, what that means is, hey, look, when we sell the thing, we're banking on a 15 IRR. And so it's positive that the total return is positively levered relative to the debt. We're not buying the deal for 6% cash flow when our interest rate is 6.5%. That's going to be the entirety. So if it was just on that, it's obviously a negative spread. You're never making any money. But if you're saying, hey, cash flow is going to be, maybe slightly negative, but the ability to slowly grow out of it, and then we'll have NOI increase over 10 years. And maybe you get a little bit of cap rate compression, or you get NOI up, and then you can sell it, getting into a mid-teens. And so there is a positive spread. But as the article says, due to expected NOI growth, which implies speculation, which could be appropriate or not.
We've talked about this just internally, but I think we've mentioned it on here a few times. Just getting deals to pencil. Credit tightening and debt sizing is being reduced. Overall, you have to bring more equity to the deal. Expenses are growing faster than rent growth, perhaps. Yeah. Or you're having to underwrite, suppress or negative rent growth. So with all of these factors, coming into play, it makes acquisitions, quite challenging. I think our value add or our leverage here in our markets is operating, in a relationship-driven business in markets that we're experts in. So when we were down in Miami, just discussing some of our tertiary and secondary markets in Indiana, you kind of see the eyebrows raise up of, never even heard of that market before. Yeah. And so there are those diamonds in the rough that you can find, but it has made acquisitions, quite challenging. Yeah. So you can understand why the transaction volumes maybe have been low, but it's good to see as the article started, there's been a slight uptick in transaction volumes towards the end of the year.
Yeah. Yeah, I had an interesting conversation, a few interesting conversations when we were in Miami last week. And we have a good episode that we did on Friday that kind of gives a really nice kind of wrap up of, what are some of these, institutional investment conferences like? How do you network? And what are the conversations that take place? One of them was another GP, I think more of a developer in the Southeast, and mentioned it was from the Midwest. He's like, "Oh yeah, we really like those markets." Because they got really beat up early in COVID, though, right? Like really, really beat up early in COVID. And I looked at him like, no.
Yeah, who told you that?
I'm like, I don't know where you're getting it from. Maybe you're thinking of Minneapolis. I mean, Minneapolis was the one market that
urban core for sure.
Yeah, in urban cores everywhere. Mm-hmm. But I'm like, no, sorry, you're mistaken. Like Indianapolis, for example, had the second least amount of job losses in the entire country. Only Salt Lake City fared a little bit better. Almost lost no jobs. It was essentially flat, and we maintained positive rent growth throughout COVID. And over the last couple of years, when the rest of the country has been negative, we've been compounding positive rent growth. So I'm just like, sorry, I don't know what you're speaking of, but it was an example of the lack of knowledge of some of these markets. And other criticisms in the Midwest are liquidity. Is there enough liquidity in the market? When I want to sell it, is there going to be a buyer? Some markets are more liquid than others. Admittedly, we've got, in Indianapolis or Columbus, tons of liquidity, never going to have a problem. A more tertiary market like in Evansville, perhaps, or Terre Haute, which we own there. We love it, good cash flowing markets. But there's less liquidity. There is liquidity and there's ample liquidity, but there is a slightly different risk profile. And the question that again that we've talked about a little bit last week is about, I guess, the premium or discount, or the perception of a premium or discount that should be attributed to a Midwest market that one might call more tertiary. Even they're talking about in the Midwest, they might be secondary or even primary markets.
Sure.
Again, Columbus, Indianapolis, Kansas City as examples. And the question was, why should we be okay with a mid-high teens IRR in Indianapolis, 16, 17%, when we can go to a primary market and get a 16, 17%? At first, I was like, well, I think it's a good question. We think, but the answer is, even though it's counterintuitive, because it's like Midwest, it seems emerging, it seems tertiary, what's going on there? The fact is, it's lower volatility. Lower volatility equals lower risk. You can plan, you can underwrite it. If you go back through COVID, even go back to the GFC, Indianapolis fared very well during the Great Financial Crisis. Was it good? No, it wasn't good for anybody. But our housing prices did not see the declines like the rest of the nation. The job losses were a fraction compared to other metros, and just was one of the most stable, not just Indianapolis, but the whole region was very stable rest to the rest of the country and the entire globe. Next stress test, COVID-19 pandemic, same thing, more stable than almost any other region. The growth was consistent, low volatility. So we still were able to achieve growth. And so again, risk is return. If there's lower volatility and less risk, you would expect lower returns. Just because you're not as familiar with the market, just because it might be a flyover metro that you pass over on your way from New York to Los Angeles or wherever you may be going, doesn't mean that there's not solid demand, doesn't mean that it's low volatility, and you can't make really good money. But just people haven't been as familiar with it.
Right. And we could argue that the liquidity is improving or increasing. As we do have some more institutional allocators, owner operators entering our markets. We've noticed that just in our acquisitions, the competitiveness has increased, and just relative to some of the headlines and this stability of our fundamentals, that will only increase, in my opinion, during our hold periods.
I certainly get the feeling that we're in pretty early innings. I mean, it's not like you're so early before that there's a trend, but you're not too late.
Sure.
And so that's where I think the surprise comes, is that I think folks assume that, well, man, I'm going to be early because no one is investing in these markets yet. I can get in and I can get just a huge discount. And so I can get, mid-20s IRRs. It's like, well, I mean, not all the institutions are here yet. In fact, it's very early innings of the institutions, but all these private buyers, private equity groups, local buyers, regional and, just one-off groups from the coast have been very active here for a while. It's becoming slightly more efficient. And it's not the secret that it was a couple of years ago. It's not like in 2017 when I went to NMHC and there was almost no mention of the Midwest other than Chicago. It's at least getting it's now being mentioned. It's not getting the 10 minutes that's dedicated to Dallas Fort Worth. And when then just Midwest is just footnote, it exists. Right. Now it's getting 5 minutes, and in Dallas Fort Worth is still getting its own 10 minutes. But the Midwest as a region might get 5 minutes this year for NMHC. So it's not a complete secret. This is the issue that we're dealing with that we're sharing on the screen, the multifamily stabilized value stack. And we're looking at this equity spread. It's negative. That black line is the cap rate. And then the debt spread is, I think it's purple. I'm slightly colorblind. There's a magenta up there, I think. But, again, the debt is becoming more expensive than the cap rate, which is a big problem. Basically we have to go back to 2007, 2008 for that to be the case of when that equity spread really tightened up. That's when a lot of distress was taking place, a lot of hardship. But it's also when the most attractive acquisitions took place right after that period. And really just after 08, 09, and 10, some incredible opportunities to pick up multifamily assets. But the difference potentially now versus then is that I think you have to be patient. That snapback probably isn't going to come as quick. And that's due to so much oversupply that we've seen. And I'm just going to fast forward to the chart that I'm pretty sure is on, right here. Multifamily value index. I thought this was a really interesting chart, Griffin. I don't know what you thought. But again, looking at these two red sections of the chart, the GFC back in 09, but really kind of the valuations starting to recover at the end of 09, through 10, and basically through 10 they had recovered. Much quicker recovery versus fast forward to 2023 when we started seeing value declines as the Federal Reserve began increasing the Fed funds rate. Pretty quick declines to reset because those interest rates are higher and you just can't pencil deals. It's so negatively levered. But the stair step is much more gradual for the recovery. We're already looking at a much longer period of recovery than we experienced back in the GFC. And I don't expect that to accelerate so quickly without a major drop in rates, not just the Fed funds, but especially the longer term duration Treasury yields. So, but patience is a virtue. Know that. Don't get too excited. Don't get over your skis. Because again, we've got NOI that's not really growing that much right now. But damn, if I'm a technician, if I'm looking at doing some elementary technical analysis, right? That looks like a recovery, and we're pretty much there. We've got one positive blip on the screen.
We've got an FOMC meeting in it's
a couple days,
3 days,
2
days maybe. What's the gut feeling, Spencer?
I think they're going to see another cut. I think it'd be shocking the market if they didn't do one. Obviously, they're leaving some questions out there, not wanting to be overly certain. I might expect we'd see another cut just because I think there is continued concern of just the labor market being relatively weak. I think I'd have to see what the market is pricing in, but I want to say it's got to be pretty closely priced in at this point that would be getting a cut. I don't know. What are your thoughts?
Just from reading, really being a little bit involved in a lot of the articles following Fed governor speeches, taking a look at some of the really kind of that core data that has kind of been foggy and hidden through the government shutdown for a long time. It seemed like there were a lot of bifurcated opinions in the Fed. The Fed governors left or right, wishy-washy. They were kind of divided. It seems like everybody is in favor or leaning towards that 25 basis point cut, not to give you a specific size, but that seems to be the direction upon which I think they're headed. So it'll just be interesting to watch again this chart. As you said, as values will increase as rates come down. really across the last quarter of 25, and then into 26. It'll be really interesting to see if they continue to make those cuts or call it a day and hold it steady.
Yeah, I've heard different speculation that, maybe there will be some more cuts in 26, but maybe fewer of them. And maybe we've kind of gotten through the cuts until there's some more economic data. But obviously, we're going to be looking at a new Federal Reserve chair in 2026. Yes. And so it could be a different direction. Obviously, the Trump administration is strongly advocating for rate cuts for a variety of reasons. Mm-hmm. So we're seeing a lot of politics interplay with monetary policy, which you could say is not good. I don't think it is, but it's really nothing new. Unfortunately, I think every president has really pushed for lower interest rates because it's usually good for the economy until it causes a recession.
Right.
I want to talk about affordability.
Yeah, I really liked the data visualization that this Oxford Economics research briefing, housing affordability remains strained across metros. The data visualization was really the most powerful point of this. There's all sorts of data listed in the copy that I think is meaningful and valuable. But I think for our purpose today, some of these data visualizations will really tell the story. And this really just marks and tries to identify the lack of affordability in major U.S. metros, specifically the most expensive and then the most affordable. And so I believe we're looking at what would be the more expensive markets across the United States. The red squares on your right are 5 years ago in Q3, the relative number of households that could afford a median priced home in the United States. And so just looking at the severe decline, from upwards of 50 to 60% down to less than 40% in Washington. Let's grab a few of these that we maybe are most familiar with. In Miami, in 2020, it seemed like maybe 45% of households could afford, a median priced home. Whereas today, it goes almost to what would be 21 to 22%. So it's just a drastic decrease of individual or of families that could afford this median priced home. And it's kind of across the board. And you can see the spread and the reduction of overall families that could afford the house. And then, if you scroll down just a little bit, and if there's this market there you want to mention, that would be just fine. But I'd like to go down to a very similar graph that highlights the one more page, I believe. Yeah, these are the most affordable metros in the United States. And you see there's a lot of Midwest markets included in this list on the left axis, but specifically Indianapolis, where we sit today, and where Gray Capital is headquartered. Back in 2020, over 70% of households could afford a median priced home. Whereas in today, in one of the most affordable markets in the United States, there's maybe 45 to 46% of households that can afford the median priced home. And then take a look at Kansas City and, give me your analysis on that, because it is quite a drastic reduction in overall families that can afford a median priced home.
Yeah, I misread this at first, and I thought that I was mixing up Nashville with Kansas City because obviously, Nashville has had a lot of rent growth over the last couple of years, and I think that we'd have to go stretch this graph back probably 15 years for the spread on Nashville to be as wide. But Kansas City stood out. I mean, it was one of the most affordable metros. Of mid 70% of the population could afford a home, and now all of a sudden it's down below 50%. That's a huge swing, and surprised me. It surprises me that Pittsburgh is still relatively affordable, one of the most affordable metros. It makes sense from a standpoint of that. More and more investors are looking at Pittsburgh as a market. It's one of those that's obviously it's in Pennsylvania, part of like kind of that eastern seaboard, but it's much further west, and so it acts like a little bit of like a Midwestern market, although it's like definitely technically not in the Midwest. That stood out to me as well, but that's a huge shift at Kansas City. Now, relative to going back to the first set of markets that are the most unaffordable, I mean, pretty much all of those markets are significantly more affordable than all of these very high cost of living metros. So if we're San Jose, I mean, we're only looking at 10%. 10% of the population can afford to live, can afford to buy a home. And I also believe that, these are just taking into account the mortgage payment. I don't even think we're really talking about, down payment and the whole cost of home ownership.
Right.
And so it's even more unaffordable than sometimes the reports and the studies can really portray, which is, unfortunate. I mean, it's, I don't know how you feel, Griffin. I mean, the more that single family homes are unaffordable to buyers, it creates more renters.
Mm-hmm.
In our business, that's more demand. That's more customers for our business, and that's a good thing. We provide high quality rental housing to folks that are looking for it.
Right.
But from a perspective as an individual who is maybe wanting to own a home, it's not great news. I'd argue that there's a lot of different ways to build wealth beyond buying a single family home. But buying a single family home has been kind of the playbook of the American dream for a couple of decades of it's your nest egg and it's how you build wealth. We can argue whether that's the safest, the smartest, or even a good, path for most people. Is it more of I think, owning a home, it's turning into more of a, kind of a luxury item. And, than it has in the past. But I think that if you get beyond like, I need to own a home, I deserve to own a home. Like if I can't own a home, I can't get ahead in life.
Mm-hmm.
I think, you should look at shifting your mindset a little bit because, when I have conversations with younger people, especially like, it's gonna be hard for me to buy a house or regardless of the thing about their finances. And this is to get back to, what, Rich Dad, Poor Dad, teaches is that it's, it's really focusing on your balance sheet, and you need to be adding assets to, your balance sheet.
Yeah.
Your net worth statement.
I was just getting ready to say that. For some reason, the single family house gets listed on there, but depending on the season, the day, sometimes it feels more like a liability because you continue to put money into your house to improve it, to fix things, to maintain it, to insure it, property taxes.
Way too much emotion tied up in it to be a sound investment.
Right. Yeah, exactly. So the poster child for this, and I hate to throw my little brother into the live stream here today, but a 25-year-old who is, hopefully one day going to get engaged to his girlfriend and get married and then do whatever it is that they want to do. And I think just being from Indianapolis, being born and raised here, that, Midwestern roots, buy a house, have kids, raise a family is really how we grew up.
Yeah.
And, times are changing. Priorities are shifting. The world is so accessible now that this transitory jump from one city to the next to go and explore with, be youthful and explore instead of establishing roots becomes, quite attractive to folks like my little brother. And there's certainly nothing wrong with that. And I think it sounds quite exciting. But there's a part of me and how I grew up and how I was raised that really prioritizes having this plot of earth that I know that I own, that my kids can grow up on. My wife and I, we can make it into our family homestead and go from there. And it's for us, the perspective is not about generating a balance sheet, but it's about having security and comfort. So for my little brother, who's always
lifestyle,
potentially maybe moving around, lifestyle, will he ever have that place that he can come home to and know, that he's safe and comfortable and can, raise his family in one place with the same group of friends in the same school district, all of those things that kind of come with that home ownership that in my opinion can't necessarily put a price on. However, as we continue to have this, I own an older home, continue to have this house, it's just seemingly more and more and more money coming out of my bank account, going to the plumber. So maybe I need to give it Joe and learn some skills, but building the balance sheet, I'm always curious why my single family house is always listed on my net worth statement.
Well, and when you're taking out a loan, oftentimes, your home is taken off.
Right. They won't put it on there.
Yeah. For that exact reason.
I just want to mention this as well. This is interesting, especially when you start thinking about some of the younger generation that maybe the college degree is waning and they're going into the trades, and there's all of a sudden a need to generate income to be able to afford a home. And I just think this over the last 5 years, none of these incomes needed to afford a median average or median cost house have doubled, but this chart looks like they dang near have doubled. And so it's just quite intimidating to think about what 2030 will look like relative to 2025 as things get more and more
I mean,
expensive.
I think that's the perspective that we should be thinking about. Of, does this get better? How does it get better? Does it get worse, or does it stay the same?
Right.
We don't see the action or anything that's changed to say that, like, this is clearly going to get better.
Mm-hmm.
Houses aren't getting cheaper to make. And it's not as though wages are rising at a record pace of where they're going to be able to outpace. Now, even if interest rates come down, maybe that helps a little bit, but
Sure.
then you always have this problem of interest rates coming down. Someone's willing to pay more money for that.
There goes the
property.
values of the house going up. Yeah. I just thought it was interesting that the affordability has decreased in such a drastic way. That's why I wanted to pull this up, because it does lead to hopefully improved business at Gray Capital and for multifamily investors as the demand for multifamily housing continues to grow.
Yeah. And the key is, we need is more investments into housing, whether investment into multifamily housing, whether existing, new, single family, duplexes, affordable. We just need more. If we have more supply of places to live, or we also need to maintain our current supply. That's another piece that gets left out, because we'll demolish so many units a year, which takes supply off the market. Now, sometimes it's obsolete supply, but a lot of these value add operators are actually serving a very useful purpose in the ecosystem by maintaining aging housing stock. So it prevents that housing stock from going offline. And so we need more housing, or we need more investment into housing, kind of regardless. But we certainly need to build more housing in the United States, which would not necessarily be, good for returns for multifamily investing, but just looking at, what we need as a country, we certainly need more supply, more investments into housing. And we'd like to see that going forward. But unfortunately, we're not seeing the evidence whether we're going to see that supply.
Yeah.
And multifamily does pretty damn well if we do build a decent amount of more housing. And if we're in an unfortunate situation where we still have this housing crisis, multifamily does exceptionally well. And so, is it a hedge on that, and just kind of looking at reality in the face and saying this is where we're going? There is certainly a little bit of that element of just kind of calling it how we're seeing it. So again, if you're interested in getting these articles sent straight to your inbox every single week, hop on over to graycapitalllc.com and you can sign up for the Gray Report newsletter. It's the best newsletter in the market. All right, next, we want to have a little bit of a discussion. Gone through these great reports. Want to have a discussion with Griffin on why would someone invest in multifamily? And why would someone not want to invest in multifamily? Griffin, I know you're an LP in several multifamily deals. You're in some of the Gray Capital deals. You work with investors, limited partners, institutions on, telling them about what Gray Capital is. And usually we're not in a position, because our investors typically, not 100%, but often are elevated on the sophisticated spectrum to where, like, they already know why they invest in multifamily.
Yeah.
You are rarely, pitching someone on you should invest in multifamily. I guess unless you meet somebody on the street and they're like, "What do you do?" And like, "Why should I do that?"
Right.
But talking to investors, what are some of the main reasons why someone might invest in multifamily?
Right. I think at Gray Capital specifically, with our offerings being available to accredited investors only, we are talking to individuals that have already put the work in to generate wealth. And so they understand the value of a dollar. They have disposable income. They're likely allocating to different buckets, whether it's fixed income, equities, some kind of alternatives. The rationale of accredited investor allocating, let's just call it our minimum, $100,000 into a direct deal. It's kind of across three lanes of not value store, but relatively low risk for what is a palatable return. So you take a look at the stock market, and there's a lot of volatility, and it can sometimes be quite difficult to understand. And so I think in real assets, or specifically multifamily housing, we always say this all the time: you can come through, you can kick the tires, you can touch the asset, you can drive by. It's very real.
Yeah, it's a physical thing.
It's a physical thing. And once you've begun to get introduced not only to multifamily housing, but specifically our markets in the Midwest, you can see that the volatility is almost, it's not non-existent, but it's much reduced. And so they're relatively interested in putting their money into a real asset whose value will likely hold with limited volatility in order to maintain the value of their funds that they're investing. And then on the back end, if you partner with an operator that is trustworthy, prudent, has a reputable track record, you can obviously begin to reap some capital gains or some you can multiply your money. But along the way, this is the second bucket, is just cash flow distributions. So we have investors that will come to Gray Capital, old and young, but a lot of these folks that are really more focused on the cash flow that multifamily assets will kick off, these folks are preparing themselves for retirement. They could be entering into retirement. They might already be into retirement where they're looking for that supplemental income, to where at Gray Capital, we're making monthly distributions where other operators might be making quarterly or semi-annual distributions. But there's essentially that mailbox money component to it, to where if you do invest into a real asset and it's a cash flowing asset, you're able to receive those monthly income distributions to then use, to afford your activities.
Whatever you want to do.
Yeah. The third bucket would then be some kind of tax advantage, to where you're already a successful individual. Maybe you're realizing, a certain number of passive gains in previous investments, but you're utilizing an investment into a real asset to reap the benefits of depreciation or some kind of tax deferment strategy. So we have folks will come to us specifically this time of year, at the end of the year, looking for, maybe some passive losses to go on the books for 2025. But there's also, other strategies that these investors will use to defer taxes from a sale of a previous real estate asset, and or kind of offset any other passive income that they've otherwise been able to make through other investments. And those would be the three main buckets that I can think of off the top of my head. Be curious as to what else you.
No, I think those are definitely kind of the three things you said, which is, first, a solid total return with relatively low risk, and it's perceived risk. Nothing has zero risk, and
Right.
we got a couple of questions about how low risk it actually is. You mentioned cash flow, and that's what I hear all the time. It's consistent cash flow. It's a cash flowing asset, and then you combine with the third, but it's also tax sheltered cash flow, and that's one of the tax benefits. Third kind of column that you mentioned, which you hear a lot about. And I think there can be some confusion on the tax benefits because different individuals. Tax situation is different. If it's a lot different, if you're a real estate professional, if you have that status versus if you don't, you need to consult your CPA to make sure that you actually do qualify. Most people don't, but you'll hear a lot of times as syndicators or folks say that, they'll talk about the tax benefits, assuming like you're a real estate professional. But you have to, log quite a few hours every single year, to get that real estate professional status. And you certainly don't want to be claiming it if you don't. But incredible depreciation benefits, be able to offset income. If you can do a cost segregation study, get all those losses, accelerate them in the first year, and just have a ton of passive losses that shelters future cash flow. But also, can offset, the capital gains. If you sell a property in the same year, those losses can go in and offset that gain. I mean, my family's been using this effectively for basically the last 10 years to essentially shelter all of our capital gains when we sell multifamily property, then going into, as we, roll cash into the next investment.
Right.
It's not all perfect. It has to line up. Obviously you can run out of losses. But it's been a really effective strategy, and it could also, it's sometimes referred to as kind of like a lazy 1031.
Sure.
And often is the only option that one has when they're investing in syndications, because a lot of times a 1031 out of a syndication often isn't possible. You typically have to get about, I think, 51% of like the owners of that entity to flow into the next deal, and usually a bunch of different investors.
Yeah.
Not everybody wants to roll it into whatever the same deal is. But some just additional reasons, diversification is one. You hear a lot of folks will say either, I'm totally invested in the stock market and I want to get exposure to alts. I want to get exposure to, real assets, hard assets, like you mentioned. And, real estate is one of those. And so, multifamily having great economies of scale compared to other real estate asset classes, whether that be single family rentals or, commercial office buildings, industrial buildings, or retail assets. Multifamily is perceived as, relatively kind of lower volatility, lower risk, but still a strong return,
right,
and a really good diversifier when one is looking at kind of portfolio construction. And you're looking at your public equities or stocks, you're looking at your fixed income bonds, you've got your cash, now you've got a little bit of crypto here and there. Real estate is very advantageous and has the ability to increase the Sharpe ratio, which is essentially, that ratio is determining, how much, risk and return is one taking. And you want a good Sharpe ratio is essentially meaning that you're getting so good return without taking that much risk. And a piece of real estate, because it's relatively uncorrelated, not completely uncorrelated, but relatively uncorrelated to some of those other asset classes, it can be a really good kind of anchor, but at a higher rate of return,
right,
but reducing some volatility.
The diversification is, like you said, a big reason. And just because we mentioned it earlier last week in Miami, there's all sorts of different alternative buckets, whether they're real assets or whatever it might be, venture, private equity. Each of these buckets has a relative risk associated with it. And I think in the world of real estate, if you're an allocator, you're an investor, you take a look at real assets, specifically multifamily real estate, you realize that the return for the risk profile can be quite favorable in regards to the return and risk profile of other buckets. The one thing that I also wanted to say was you mentioned 1031 exchange.
Yeah.
Real estate, specifically multifamily housing, can be quite a powerful vehicle for generational wealth transfer. We had an investor in one of our properties here in Indianapolis, is a young business owner who's been really successful. He put money into one of our projects that he simply didn't foresee needing access to here in the next, and for the foreseeable future. And his plan was to continue to roll this investment from one of our deals into one of the next, continue to roll this through 1031.
Yeah.
And I thought that was really, really amazing because he was so young and he realized the value of this 1031 exchange for his children.
Yeah, if he does this for the next 30 years, 40 years.
Whatever it might be, and then at his death, the step up in basis that occurs in a real estate play can really pass along generational wealth. And that was another reason. It's just kind of estate planning purposes of setting up the next generation, your kids or your grandchildren, for success in the future through real estate investments.
Yeah. Before we get into some of some of the myths, like challenging some of these reasons to invest in multifamily, there's reasons not to invest in multifamily. We put together a list, and some of these I immediately kind of counter some of them of like, well, not necessarily, but what are who shouldn't invest in multifamily, and why might not it be a good investment for some folks?
Right. I think there's the first thing that jumps into my mind is just the illiquidity, the illiquid nature of real estate. If you're making an investment into a real asset, specifically multifamily housing with great capital, our typical hold periods are somewhere between that 5 to 10 year mark. So if you make that allocation, in order to receive your money back, we would need to have a capital event where you need to sell the asset or refinance. Or there are secondary markets, but the liquidity there is not as plentiful, so you're going to be taking a discount. So if you're thinking about investing in a multifamily asset class and you're potentially want to invest $100,000 that maybe you might need in 2 years, 3 years from now, real estate's probably not the correct investment for you, just because that $100,000 will be locked up per se in the asset for the foreseeable future or the projected hold period. That would be the first reason. The next thing I'm thinking of is just, relatively probably sage advice across all investments is somebody that just simply doesn't understand, the value levers of real estate and how the returns and how the overall structure works. I would never advise anybody to make an investment that simply just doesn't understand the operations of a real asset or a multifamily investment. And those would probably be the two largest ones that I can think of just off the bat. But the illiquid nature of real estate would be the first and foremost. One that I think a lot of our investors, they do understand, but we always have to remind them that, hey, this is a 5 to 7 to 10 year hold. Are you okay with the illiquid nature of this investment? Yeah,
no, I think that's absolutely correct. And number one reason not to invest in real estate in general or multifamily is that the issue of liquidity. It's not like the stock market where you can go on your phone and you can sell a stock and have access to the cash immediately. Even if you wanted to, sell a property, you can't just, even if you're the GP, the sponsor, you can't sell it the next day. It's easy. It's often, at a absolute bare minimum 30 days. That's like record time. It's happened, but it's record time. 60, 90 days is much more realistic. It can even be longer from time to like actually start the process to closing on it. And if you're a limited partner, an LP, passive investor, you have no say necessarily in that sale. Then you could try to sell your positions, but as you said, there's a secondary market for that, but it's a pretty opaque market. Often those positions are traded at a discount because they are illiquid. There's less information on it. And so it's not, if you need the money back, if you have to be okay with, kind of locking it up. And I've talked to a lot of investors that like that about multifamily. You could just have some discipline on your own with the stock market or whatever you're investing in, but they liked it. It's like, I can't touch it. Like, I've invested it. It's over there. I can't panic sell it.
There's no stress about making the wrong decision on when to exit. Truly.
Yeah. I think it's a lower anxiety investment in general.
Right.
There's some other negatives, which again, I think there's a lot of these that like I immediately would say like, that's not necessarily the case. But it's a high barrier to entry and illiquidity, just a high barrier to entry. They're talking more about, at least on this list, the last multifamily property we bought required $25 million of a down payment to buy the property. Who's got $25 million? I mean, even if you're a, centimillionaire, you're not putting, you got $100 million. You're not putting 25 of it down on one property. You shouldn't
quarter your wealth on one asset.
No, you shouldn't do that. So if you're a billionaire, that's still, I mean, you could do it when you're a billionaire, but you don't have to be the sole check writer. That's the power of syndication and, pooling capital together to go and buy these institutional assets. But there still is that barrier. You have to be an accredited investor to invest with a group like Gray Capital. There are other sponsors that will accept non-accredited investors. They're doing 506B exempt, SEC exempt projects, maybe some Reg A deals.
Right.
But usually, the minimums even on those are going to be $50,000. Some, can be lower, 25,000, 15,000. I'm not going to say absolutely, but sometimes the quality of those sponsors and deals can decline as the minimums go down. Usually as someone becomes a better operator, they typically increase their minimum. They don't typically lower it. That's not a rule, but it certainly is a thing. Transaction costs, they say, is a negative. And that's definitely true. You got to pay typically a broker's fee. There are transaction costs. There's a good amount of fees. If you're investing in a syndication, there's acquisition fees. There's all that type of stuff. Yeah. In a sense, it's more transparent because, there's fees if you're investing in the stock market. Also, they're often hidden. I'd also say that most of the fees are kind of baked into the overall return. It's not like you have like a gross 15 IRR and then like you as an LP pay a broker's fee.
Right.
Your return that like a sponsor like Great Capital is going to project is, net to you, and you're going to make your adjustment, your assessment and decision net of all the fees that you know about.
That goes back to just the general understanding of the investment structure, how all the gears work, and how at the end of the day you will receive your money back in any returns and gains.
Yeah.
I think some of my favorite conversations when we're raising equity for our projects and are the ones of the successful real estate investor who has a portfolio of small multifamily properties, who's maybe aging out or is just looking forward to maybe taking his hands off some of the operational headaches and the day-to-day, maintenance requests. And I think there's a group of people out there that has the bandwidth and, the hunger to go out and work for the returns. But as a Great Capital investor, or if you're investing in a syndication, you're a limited partner. And so it is very passive. You're not in the units every day, changing light bulbs, fixing faucets, unclogging drains. You're not leasing units. But if you are an active investor and you go out and you want to buy your own 8-plex or your own quadplex or a small multifamily asset, you're thinking that, you'll be able to boost your returns and maybe outpace the growth of the returns of a gray capital passive investment. I think that's another barrier to entry, or maybe a reason why somebody shouldn't invest into multifamily is because if you're going to do it on an active, where your own blood, sweat, and tears and your own money are going into the asset, sometimes
in your own time.
If you buy the wrong asset or you make the wrong decision, you mismanage the property, more likely than not, your returns will come down. If not, you might have to sell that property at even, break even, or potentially at a loss. And so I think if you're looking to invest in multifamily, the challenge there is identifying, a group sponsor, a manager that has the bandwidth, has the experience, has the expertise and the relationships to ensure that your money is being placed in an asset and will maintain its value, if not more. We've talked to people all the time that are transitioning out of these active portfolios into passive. And more than anything, that shows them an appreciation for what we do on a daily basis.
They're happy not to have to deal with it any longer.
Yeah,
it's a really good point in that folks often underestimate the amount of time it takes to manage their properties on their own. And not that it's rocket science. Real estate is only so complicated. It can be somewhat complicated. It can be nuanced. You can get really into the weeds. Anyone can do it if you put the time to learn it, to put the right teams together. But you just have to know that, especially if you're doing a larger multifamily, you're getting in the ring with professional investors. This is all we do. This is all Gray Capital does every single day. All we do is think multifamily. All we do is look for deals. All we do is manage properties 24/7, 365. We are living and breathing multifamily. And so if you're like, hey, I might pick up this property over here, it looks interesting, and I'll manage them myself, on the weekends, I can pop over. I enjoy kind of doing repairs, or, I'm going to hire a third-party property manager that's not going to be very active because someone else is going to be, doing the repairs. Think twice. I mean, we have a property management company. I still have to be really involved. I've owned properties with hiring third-party property management companies. There's still so much work to do every single day.
Yeah.
And asset management, property management is a huge time sink. And that's where, an LP being a passive investor can be attractive because, that work is essentially offloaded.
Mm-hmm.
Now, where it gets tricky is if you don't invest with the right sponsor, and that sponsor goes belly up. I've seen cases, you're familiar too with some, I think the example of where, the LPs have to step in because the sponsor goes bankrupt, and then LPs are, they're owners of the property.
Right.
And then all of a sudden you went from being a passive investor, just, working your W-2 job or sitting at home retired, to all of a sudden you have to manage this, multi-hundred unit property in a market that you're maybe not local to, and you have to figure it all out
while still working your job.
Right. So, that's not going to happen if you're, a small investor, buy stock, in you buy S&P 500, buy the index, never, no chance of that ever happening. But what you miss out on in an ideal world, if invest with the right sponsor, this is an advantage we didn't mention, is the ability to force appreciation.
Right. I was going to ask you to tell the story of Mad River and the refinance, the power of the refinance, the perpetual returns, asset appreciation.
Yeah.
That's another really strong reason to invest.
Yeah. So this asset, I think it was Oakdale. Oakdale is the one you're thinking about. No, we recently, a couple of weeks ago, we actually sold this asset. It's one of the earlier assets we acquired as a co-GP at Gray Capital. And we refinanced it twice, pulled 100% of original capital out twice. So, I think it was like 2.2 in equity, or, a little over $2 million of initial equity investment down payment to the property. We were able to pull, I think almost $3 million out on the first refinance. Then we were able to pull another $2 million out on the second refinance. And now we've just sold it, returned capital, and we're distributing another $2 million.
Right. So you're at a 2x multiple before you even sell the asset at that point.
Before we sell the asset.
Yeah.
Now, we, on our LP position, it's a 5x return. Man. On our GP position, it's closer to a 9x.
Right, man.
That's a unicorn. Don't expect that. Don't ever expect that. We weren't expecting that. Weren't planning. It was not in the pro forma.
Right. And that goes back, you were mentioning just value appreciation, asset appreciation. That was a value add project.
Value add.
So that's forced appreciation.
Forced appreciation. Yeah. And so what that is, you're thinking more exponential growth rather than linear growth. You get $1 extra a month. That's great. It's $1 extra cash flow. Obviously, there may be some expenses that come from that. But that $1, if you put a cap rate on it, you put a 5% cap rate, that $1 turns into $20, pretty quickly. And so if the more you can, for every dollar that you can increase NOI, you're getting a multiple on that dollar increase. And so, it can be slow growth, slow cash flow. But again, when someone goes to value it, they're taking that NOI, they're dividing it by that cap rate. And so it's at an exponential growth rate. The lower the cap rate, the higher the steeper the curve. Exactly.
You've got an accredited investor, hardworking family man, family woman, family. They've earned their right to be able to pick and choose where they're allocating their funds. They've got their buckets. They've got fixed income. They've got equities. They're diving into this alternative space and real assets. There's all sorts of different, commercial real estate assets that you can and should invest in for the diversification.
Yeah.
Industrial, self-storage. I've even seen people more recently than not, they're investing in this iOS, industrial outdoor storage.
Yeah. I like
parking.
that.
I can name real assets for a long time that I hadn't known about. There always seems like there's a new emerging, maybe there's changing
data centers.
There's all these new real assets that are coming in this kind of muddied water of alternative real estate offerings. Why does multifamily stick out to you? And why did you choose to establish your business in the multifamily space?
It's a great question. There are others. There are some other attractive commercial real estate asset classes, and multifamily isn't like the only one that's like I'll only do multifamily. But it is my favorite. Part of it, it's got the deepest capital markets. Has the most investor interest. Has the highest degree of liquidity and the long-term, fundamental thesis of, of not having enough housing and the population shifting to being more of a renter nation rather than a single family home owning nation is only going to continue to perpetuate. I mean, that's very similar thesis when we started back in 2015. And when we were just looking at the Oxford Economics, these metrics, I mean, that has certainly come to fruition. And as we were talking about, going out to 2030, 2035, 2040, what's going to change that trajectory? So there's these long tail, fundamental reasons of why multifamily is going to be attractive. It also has, elastic demand. So there's always demand for housing. You always are going to need, a shelter over your head. Office, not necessarily the case. As we've learned recently, offices are kind of sometimes optional. That demand isn't as strong, especially in a work from home environment. Industrial, I mean, yeah, we're going to need places to do business, but the needs of businesses and what we're storing and what we're building can shift dramatically. Also, apartments, we didn't mention this in some of the benefits. And I think in the last couple of years, it's a little bit more of, not a question, but more a nuanced topic, but rentals are an inflation hedge. You're resetting your rents on an annual basis compared to commercial office or industrial or any other commercial that are typically on 5, 7, 10, 15-year leases. That sounds great. There's security in that. However, if inflation is really high and you can find yourself with rents below market for years upon years, especially if you're in a 10-year lease. You rented at, $2 a foot, but now the market's at $4 a foot. You're stuck with that $2 a foot rent for the entirety. Maybe you have some lease escalate or some rent escalations built into the lease. You usually do. Sometimes they're based on inflation. Sometimes they're based on whatever you can negotiate, but there's a risk that you're going to fall behind in inflation. Now, there's also upside that, inflation, if we have a lot of deflation, inflation is low, that you're actually maintaining above market rents, but you kind of don't have that optionality. Whereas multifamily, not just on a yearly basis, but it's not like all the leases expire 1 year. on a daily basis. If inflation spikes and rents go to the moon, well, we can adjust our rates right then and there on new leases. Obviously, you have to let the old leases turn over, expire, and reset. But we have a lot of optionality to peg to inflation. And rents typically are either driving inflation or they're being driven by inflation. As we saw an incredible amount of rent growth during 2021, the first half of 2022. And then, the burners got turned down and inflation took over the rest of the economy. But the inflation was front loaded on the apartment side. If you're in a region like the Midwest, we kind of maintain consistent growth. Other areas of the country, like the Sun Belt, saw negative growth, or even, a market like, Minneapolis, like we mentioned earlier, very negative rent growth, 2020 through 2023, 2024. Now has been growing. San Francisco, negative rent growth, 2020 through basically 2024. Now it's seeing positive rent growth. But, the Midwest, it's been a little bit more consistent.
Right.
So consistent inflation hedges.
We mentioned just cash flow as a primary reason that somebody would want to invest in the multifamily asset class. You can get cash flow from other commercial real estate asset classes, but I wanted to specifically mention the difference between a multifamily development investment versus a multifamily stabilized or existing acquisition. Do you want to expand, on the difference between a development and a stabilized acquisition in regards to cash flow?
It's good. It's a great question. You say that you're in the apartment business, multifamily, and a lot of folks will just immediately assume that you build apartments. And one day we'll probably build apartments, but it's not our specialty. But there is a big difference. I like ground up development, but it's not. I don't like it as much as stabilized acquisitions. And what it comes down to, there's two reasons. One, I'm a cash flow focused investor, and there just ain't no cash flow on a development deal. Most development deals are total return focused. You're going to be taking out a big construction loan. Obviously, the developer gets a development fee up front. Big construction loan is taken out. You got to build the thing. It's going to take, probably 2 years to actually construct the property. Then you have a lease up. That's going to take probably, 6 months to over a year before you're stabilized. Then you might be able to start distributions at that point. Typically, you'd either need to do a refinance to put it on a permanent loan. Ideally a fixed rate loan, and then it's stabilized. Then the cash flow can begin. But oftentimes you are selling it at that point and just returning capital. And so it can be a great capital gains play. You should be receiving pretty high returns, because a development is, technically, it's an opportunistic strategy. So it's up on the risk spectrum. It should be high up on the return spectrum as well. So for someone that's like, I don't need the cash flow right now, and it's in a great market, high growth market, decent tolerance to risk, see a deal that's, mid 20s IRRs, typically like what I would like to see for a development deal. They've been squeezed recently for a variety of reasons.
Sure.
But when I look at that versus a stabilized acquisition, which especially in our case, the way we look at deals is cash flow from day one. So we buy it one day, the next day cash flow is coming in. We're distributing at the end of the first month of operations. So, if you are income focused, cash flow focused, there's no comparison. Just the development doesn't achieve the goals if you're looking for income and cash flow. But the stabilized acquisition also has opportunity for great capital gains. And, the great capital track record, our portfolio, we've been able to achieve an IRR, or total return, of just under 30%. A lot of that was the market. We bought at a good time. We sold a lot of properties at the right time. There was some luck involved. We're also in great markets, good partners, great teams, et cetera, et cetera. But what my point is, when your returns on the stabilized acquisitions start looking to be very similar to the ground up development, it's, well, why do I want to wait that long for cash flow? And why do I want to take that risk when the returns really aren't that much different? Now, a developer would look at me and probably counter and say, yeah, you achieved those 30 IRRs on our development deals over the same period of time. We achieved a 45 or a 50. Right. And I would say, congratulations. That's awesome. And that's what you should be able to achieve if we're achieving, double our projected total returns on a stabilized acquisition. But the reason why developers are having a hard time raising equity right now is because we'll underwrite, it's hard to find deals, but when we find a deal that pencil, like flats, we were kind of in a 16 to 17% IRR range. Mm-hmm. And a lot of the development deals that I've seen, because of cost of construction, interest rates have hurt development deals so much because they're higher risk, shorter term floating rate loans based on SOFR with a big spread. So they're paying 7, 8, 9, 10%, where we're taking out a stabilized, fixed rate loan, sub 5, we got a 4.95.
Yep.
So the cost of debt is so much lower. The cost of capital on the equity side is still available for stabilized deals because they are cash flowing. And again, look at a 17 IRR on an acquisition, 17 IRR on a development. One's going to pay me from day one. The renters are already there. There's no lease up risk. There's no construction risk. There's no interest rate risk versus all of those risks. But for the same return, at least one's scratching their head unless it's like, I really like this deal.
Right.
And I think that, they're underwriting a 6.5 cap rate. I think we're actually going to sell it for a 5.5, and it's going to, actually be a little bit better. But you can make that same argument for acquisitions all at the same time. I do think, it's important to mention in all of this is, the safe asset fallacy. I think that a lot of folks get caught up in that multifamily is a, low risk investment. And I think it is a lower risk investment compared to other things, especially depending on how you do it, but it's certainly not without risk. And you talk to a lot of investors today that have invested over the last couple of years in the Sun Belt. They're saying, man, horrible inflation hedge.
Yeah.
Because I've had, inflation is at 3% ish, but my deal in Austin, Texas has been, the rents have been declining by 8% the last 2 years.
Right.
And it's supposed to be recession resilient. Well, we're not even been in a technical recession, and there's been all these foreclosures and capital calls and deals that have, a lot of equity has been taking a big haircut, been cut in half. Some of it's gone to zero. Doesn't exactly seem like this safe haven investment. And while defaults are elevated, but they're still like pretty low. I don't know. What do you think, Griffin? I mean, obviously there's risk in everything, but is multifamily safe?
There's risk in everything. I think we tell our investors all the time when we're on a call, especially when we're buying, stabilized asset in a growing market or in the path of development and growth within the market. The primary risk, in my opinion, and I think it's, maybe you share this, I don't want to put words in your mouth, but the primary risk when you make a passive investment into multifamily would be the operator, the manager. Are they asleep at the wheel? Are they positioned to continually drive NOI at the asset? Are they positioned to handle the adversity that is inevitably going to come? And I think that when we have conversations with investors that are invested in the Sun Belt, they're invested in other markets, maybe even in the Midwest, or just deals that are underperforming, or they're getting capital calls, they're taking the asset back from the manager or the operator. A lot of these causations of these underperforming assets, or when this risk really does come to fruition and it creates a negative scenario for LPs or investors, a lot of that is just I would say inappropriate or not sound operational practices. So you talk about it all the time. You mentioned our track record just a minute ago. In the past 2 years, 24 to 36 months, we've always we like our track record. It's reputable. It's a good depiction of what we can achieve. But you always tell people, don't look at that. Take a look. We wish we could show you the deals that we didn't do. We wish we could show you the debt that we did walk away from. And I think that in a period of time, in the last 2 to 3, 4, 5 years, there were operators raising capital from limited partners that were unable to see the operator risk in the multifamily asset class. And that's in real estate in general. And I think that those are the LPs and those are the operators that are now kind of in those distressed projects, having ancillary capital calls, unannounced capital calls. And so I think the primary risk in multifamily and really investing with great capital would be our capacity and our threshold to not only, operate the asset at a basic layer, providing a community for our residents, but also the opportunity to, cut expenses, increase revenue, and produce returns.
Yeah, protect the asset.
The asset.
Yeah, position it appropriately.
You drive around town here in Indianapolis, and real estate. That's why it has depreciation. It does kind of decline in overall physical condition, and so one of the things I talk to Joe about all the time is, when we're looking at an asset, how's the roof? How are the HVACs? How are all the mechanicals? What in the physical structure, has kind of been forgotten about. And so I think there's a lot of operators that at the end of the day, they're trying to produce returns for their investors, and they're not so worried on creating a community for their residents and a safe home for their residents. So hey, we don't need to replace the roof this year because, it's going to cost X amount of dollars. We need to continually collect revenue and cut expenses. And all of a sudden that asset now goes into somewhat of disrepair, and the physical value actually, becomes less and less and less. And so at the end of that investment cycle, when they go to offload the asset, now the LPs are looking at a reduced valuation. So I just think that the primary risk is it's in Gray Capital. It's in the manager. Are we able and are we fit to, operate this asset?
Yeah, I think it's a good point. You have to look at the sponsor, the operator, and really you have to separate. And at the end of the day, you have to put them all back together, but you have to separate the operator, the sponsor. Mm-hmm. And sometimes the operator and the sponsor are different. And so, really, right. Who are you investing with? Separate the operator, the sponsor, and underwrite them both accordingly and separately from the asset itself. Mm-hmm. And then, it is, then you have to underwrite the asset. And then you have to, the quality of the asset, its positioning, where it is in its specific market. And then what's the business plan and the execution strategy? And that also takes into the market, the sponsor's ability to execute on that business plan. But you have to go beyond it looks like a nice property, it's in a good market, and you don't have to go beyond the rents may be below the market. Mm-hmm. There's a lot more nuance of, what is the execution strategy? What is the debt? How are we financing this thing? Floating rate, fixed rate, short term, long term, agency, debt fund, mm-hmm. CMBS, insurance company. All of those have different risk profiles and are appropriate for different business plans. How is the property being, capitalized, not just on the down payment to buy the thing, but what are your reserves look like? What are you bringing on for CapEx? What is the other contingencies? Mm-hmm. And then, what are the fees? Are the fees appropriate to the deal itself? All of that has to be kind of stripped out, looked at independently, mm-hmm. And then reassessed and rectified of, can this operator and sponsor execute on this business plan and strategy? And does this business plan help me achieve my goals? If you're, again, you like apartments and looks like a nice building, but you buy something that is not stabilized, mm-hmm. and it going to have very low cash flow, you might be looking at a higher risk opportunity that should have a higher overall total return, but it's going to have probably very little cash flow at the beginning. And so, that's perfect for a lot of people. They're like, yeah, I'm going to roll the dice. See, this thing is bombed out. We're going to go gut all the units. We're going to release the whole thing. But that's a lot different from buying even an older value add property, but it's still leased up. It's 90% occupied. And we're just going to fix things up a little bit, put fixed rate debt on it and hold it for 5 years. Mm-hmm. You can, one asset, one's a short-term hold, one's a long-term hold. Again, the risk spectrums are just different. The financing can be different. So you have to go beyond just the property itself. What does it look like? Do you like the units? Is it in a good location? Then you have to dig into, again, what we're going to do to it. And then again, this is sponsor trustworthy. They have the capacity to execute. And that's a lot for someone to do. Mm-hmm. Again, where people would like to get to is they find a sponsor where they trust that when that sponsor comes to them, I've got a deal. They can believe that sponsor that it's a good deal, and they understand the strategies and kind of the general, kind of the deal profile. Like Gray Capital, we don't snap back and forth between like super high risk short-term deals and then like long stabilized deal. We might vacillate a little bit between, kind of a core plus opportunity and a slightly older value add opportunity, but they're all pretty much stabilized cash flowing deals with mm-hmm. similar hold periods. But a lot of people invest in stuff that they don't fully understand.
Or just simply don't know what to look for.
They don't know.
Just don't know what you don't know. And I think a lot of the risk that's coming, to fruition in the market in the last 12 to 24 months, maybe a little bit longer, is a lot of interest rate risk. Folks that slapped uncapped floating rate debt on assets as rates begin to rise. And as a maybe entry-level investor, you see a low interest rate and they tell you it's floating. Well, what does that really mean? And what is my risk exposure here? And I don't think anybody's foresaw rates increasing as rapidly as they did. And so it's just nice to identify, hey, this could or couldn't happen, or the chances of this happening may be rather low. So, investors that, made placements into those assets where rates now kind of went through the roof and that property was unable to cover its debt, how are they supposed to know that rates were going to rise that fast? And certainly they can't, but you need to know that that is a potential risk.
Well, and that's exactly, it's a potential risk. And that's where, like, it's true what you said, that no one knew that rates were going to run as quickly as that they did. There were a lot of people, including folks here at Great Capital, that looked at the situation and were like, I think we could see higher interest rates.
Yeah.
Certainly a possibility. It's happened before.
For them to get lower at that point.
You can't, nowhere to go. But what you said is so important, that they could. And that's when I think back to when I was getting started, kind of 2015, buying deals in 2016, 2017, 2018, 2019, when rates were kind of flat, 10-year was kind of in, three, kind of like in the mid threes. It was stable, consistent. There wasn't a lot of volatility. You could make the argument that, like, let's go floating rate. That's a little bit cheaper. The requirements weren't as intense as they are today in terms of, like, buying caps. The caps weren't as expensive as there wasn't volatility. A decent argument to be made that you just go floating rate. Lower prepayment penalties, all that, more flexibility. But just something that I learned, and I learned this from my dad, and my uncle, and they kept telling me that, they could move.
Yeah.
Rates could go up and you're not going to necessarily be able to anticipate that. And even though I was much more of the mindset of, hey, we're in a lower for longer environment, how can the U.S. government ever stomach increase interest rates? We've got such a debt problem. We were not going to be able to, afford the interest payments on the debt, which I don't know how we can really afford the interest payments on the debt since interest rates have risen. But I just didn't think it was, likely. We're having this deflationary pressure from technology, and can't really anticipate, the black swan event that was COVID. Then bam, COVID happens. And even COVID happening, you can't necessarily, expect or had planned for the massive amount of government spending that took place, in the helicopter money, the quantitative easing, the lowering of rates, the PPP, the stimulus checks, all, all of the congressional, the fiscal spending that took place that eventually created, all of these interest rates. And so if you're in a deal in 2019 with a floating rate loan, you couldn't have known, but you could have known that it could be possible. Yeah. And we took that position, that strategy early on of we're just going to fix it. We're going to fix the debt. It's going to be a long-term hold, maybe take some return off the table because, we can't sell it really quickly if we have an opportunity.
Right.
But we're not in here to do a quick flip. We're here to build long-term generational wealth and get some tax sheltered cash flow along the way.
There was a gentleman this past week that tried to maybe probe your thoughts or try to sell you on implementing fixed rate on future acquisitions as the Fed's kind of posturing to bring rates down.
You floating?
Yeah, I'm sorry. Yeah, floating.
I
apologize.
Yeah.
Floating. He was kind of feeling your pulse on the floating. Yeah. And a lot of the conversation really kind of revolved around that prepayment penalty. And, I'm at the table. I'm trying to kind of soak it all in and insert my voice where, I feel most comfortable and needed. But in that period of time, it was, hey, just exactly what you said. Real estate's a long-term play. We're in it for long-term cash flow, value store appreciation at the end over time. And I feel, just to stick to your guns on fixed rate, in that conversation as you did, regardless of this elevated prepayment penalty or, a disadvantage should, the market turn in a favorable direction for dispositions, you're still going to be able to realize some gain without taking on that interest rate risk should rates go back on a, an upward run.
If there's a huge value pop, as we saw back in 2021,
yeah,
oftentimes you can get someone to pay your prepayment penalty for you. Right. Or the value increases so much that, there's $1 million prepayment penalty, but the thing is worth $10 million more. Okay. Yeah. I would love to have that extra $1 million. But you still have some optionality, and it's just a penalty. It's just something you have to pay.
Yeah.
But it's, pigs get fat, hogs get slaughtered. I mean, if you get greedy, saying we're going to squeeze out a little bit of return by taking a little bit more risk, you get what you pay for, you get out what you put in.
Mm-hmm.
And not that, again, that's a tool. It's all it is. Just it's a gun. It can be used for good. It can be used for bad. It's a tool, and the right strategy, floating rate debt can be highly appropriate.
Yeah.
And for the right risk profile, it can be highly appropriate. And I think if you have a large portfolio of real estate, having a floating rate loan, amidst your portfolio of fixed rate loans isn't the end of the world. We have, 2 floating rate loans right now. One we originated ourselves, the other one we assumed.
Mm-hmm.
I wish we would have fixed the other one. The other one we assumed, and it's got a lot of term on it, and we kind of see it as a 7-year bridge loan until we can refinance and put it on fixed rate debt.
Right.
But our entire portfolio, the rest of it, is on fixed rate debt, and we bought some incredible assets at the same time that other people were buying assets. We fixed the debt. They chose to go floating rate, and we're cash flowing these things incredibly well.
Mm-hmm.
Where other folks are going through foreclosures, having to purchase, new rate caps, and requiring cash in refinances to be able to do that, having to issue capital calls. And, we had us and them, we had similar thesis. Multifamily is a good thing to invest in.
Mm-hmm.
There were a lot of similarities to the business plan, but there were some key differences that I think we would hope that help differentiate us amongst some of the other sponsors that are out there. Nothing that we're super smart by any means. It's just that we've stuck to some key principles.
Just if you're thinking about investing, really in anything, but in multifamily, identifying, the buckets of risk. How is the operator or the sponsor could be different? How are they approaching that risk, and how are they positioning the asset to mitigate those risks and to really kind of control the controllables, to not allow those risks to get out of hand and ultimately come back and hurt you and your pocketbook.
Yeah. Okay. Real quick. We got 3
Right.
rapid fire questions. I'm going to ask you, Griffin. Just again, 10 seconds or less. Okay. Let me get my fancy chronograph here. All right. Better strategy for today. 100 scattered single family homes. You might have liquidity, control over those. You're the investor of those. Or one 100 unit building that you're a passive LP in.
I want to be the passive LP. I have one rental house, one door, not too far from my current residence. And in order to come to work at Gray Capital every day, I don't think I could do 2 to 3 to 4 of those, let alone 100, all in different markets, across whatever geography. I like the 100 unit building. Yeah,
it's scary. 100 scattered single family homes. Even though 100 units isn't the most efficient, I would much rather have a 250 unit building. But yeah, 100%. Okay, which risk keeps you up at night more? Rising interest rates or a bad property manager?
Bad property manager.
100%.
Bad property manager.
Yeah. Okay, if you could only pick one benefit, which would it be? Cash flow or forced appreciation?
Right now, where I'm in my life, I like forced appreciation. I'm young. I don't need the cash flow.
Yeah. Good answers. Makes a lot of sense. All right. Thanks for hanging out with us on this live stream. If you didn't watch the live stream, that's okay. You're just watching it on the recorded version. Make sure you subscribe, you register for our upcoming webinar. It's this upcoming Tuesday, December 16th at 2 p.m. Eastern. It's all going to be about our 2026 Midwest multifamily forecast. We're going to be going over some of the key Midwestern markets to arm yourself with some important information to make some great investment decisions in 2026. Again, it's not all rainbows out there, but we're giving you just the raw data, the information to help shape your strategy. And maybe your strategy is you're on the sidelines in 2026. Well, that's good news for us, because we'll probably be on the field buying properties at a discount. All right, we'll see you on that webinar. Comment below and make sure you like and subscribe this video. And hit the bell icon to be notified for all future Gray Report episodes and content from Gray Capital. Thanks again, Griffin. This was awesome. Appreciate it. Again, this report is just incredible. You and John just knocked it out of the park. And another good newsletter.
Excellent. We'll see you next week.
See you next week.